What's up, superhero crypto ninjas? Today we will explore the 6 reasons why CBDCs will launch in 2023. If you haven't taken a chance to watch my previous video on the introduction to CBDCs, please do so. I will leave a link in the description below. CBDCs are inevitable due to a combination of developments in the financial ecosystem, including recent changes in the payment sector, the emergence of cryptocurrencies, stablecoins, and the declining use of cash. Reason number 1. Stocks and crypto are crashing. Given the recent crashes of cryptocurrencies such as Luna, Celsius, and Bancor, as well as the stable currency UST, which proved to be less stable, the entrance of CBDCs into the financial system is unavoidable. Stocks, real estate, and cryptocurrency are all in free fall. Everything we purchased is now lower in price. CBDCs will be launched in response to the recent market meltdown because, unlike cryptocurrencies, they are centralized and controlled, avoiding future market crashes. This will represent the value of CBDCs, as well as the desire to be a stable and safe digital currency. CBDCs are supposed to provide financial stability by preventing the financial system from being unstable, resulting in financial suffering for customers. Reason number 2. Government regulations in crypto. Central banks were cautious about incorporating cryptocurrencies into the regulatory framework for fear of legitimizing them. They now feel that the shifting interest away from uncontrolled coins and tokens and towards stable cryptocurrencies pegged to fiat currencies is the solution. In such cases, the government is already debating the regulation of the digital financial space, hence the establishment of CBDC. One reason central banks have entered the crypto space is their concern about existing digital currency abuses like Bitcoin and how volatility in such currencies could harm financial markets. CBDCs will provide stability with the implementation of government regulations. CBDCs do not require blockchain technology or consensus procedures, although they are designed to be similar to cryptocurrencies. Cryptocurrencies are decentralized and unregulated, and their value is decided by the investor sentiment, usage, and user interest. They are unstable assets, making them inappropriate for the use of financial systems that require stability. Reason number 3. Increased digital fraud. The rate of crypto fraud has increased in 2022, wiping millions of dollars from people and corporations' net worth. Because there's no legal structure to safeguard the security of assets, crypto investors now have little to no protection in the market. The majority of trade in the crypto market today is not regulated by any government entity, which is a significant gap. Due to a lack of regulations and policies in the emerging industry, significant fraud, scams, rug pulls, and market manipulation has happened, causing severe misery to the financial system. CBDCs would halt the rise of people seeking quick riches by predicting the next coin to quote-unquote go to the moon. Furthermore, digital currencies will open up new avenues for reducing financial crime. CBDCs, because they are programmed and controlled, may aid in preventing money from slipping into the hands of terrorists or sanctioned parties. Even if it does make it to them, the digital ledger will be used to render it useless. Reason number 4. Inflation. Inflation in the United States and most other nations have recently reached a 40-year high, which means you are now paying more for almost everything, including your food, petrol, accommodation, entertainment, travel, and so on. Inflation is currently inflicting financial hardship on nearly half of the population, and the government is attempting to combat it by introducing CBDCs and raising interest rates. Investors were particularly disappointed by the May CPI data, as the year-over-year CPI rise dipped to 8.3% in April from 8.5% in March. Before 2022, the CPI had not risen more than 8.3% on a year-to-year since 1982. The core CPI, which includes food and energy prices, rose 0.6% month over month and 6.2% year on year. Food costs increased 1.2% month over month and 10.1% year over year. Energy prices have risen by 3.9% every month and 34.6% in the last year. Used vehicle prices rose 1.8% in April and 16.1% year on year. They propose that the CBDC interest rate might be the primary mechanism for implementing monetary policy. With cash gone, the interest rate might be raised to any negative levels, effectively eliminating the zero lower bound on normal rates. While the zero lower bound on central bank reserves have been broken in many jurisdictions, the zero lower bound on nominal interest rates has frequently been utilized by central banks to justify positive and distortionary inflation targets to gain some room for maneuver during recessions. CBDCs would allow a shift from inflation to price level targeting. Reason number 5. Declining use of cash. The use of currency is significantly reducing in this age of increasing digitalization. Since banknotes are widely available to the public, they are the most visible form of central bank money. The emergence of private digital currencies that function independently of a central entity and financial intermediation has piqued curiosity about how value might be exchanged. In contrast to traditional payment systems, which rely on a single company administrating a centralized ledger, distributed ledger technology can now allow a diverse set of participants to update a shared synchronized ledger. As a result, central bankers and others have begun to reconsider payment system foundations in light of distributed ledger technology and other technologies. With the rise of cryptocurrencies, stablecoins, private projects like Facebook/Libra, and the clear digitalization of the global payment systems, central banks must react and position themselves in this changing landscape. Furthermore, as the primary authority in charge of the money, central banks must examine and investigate the possible prospects and risks of new digital currencies for the financial industry. While central banks have been researching distributed ledger technology and CBDCs for more than a decade, interest has increased significantly in the recent years, in part due to an acceleration in the declining cash use in some jurisdictions. And finally, reason number 6. China Digital Yuan Pilot. In April 2020, the Chinese financial economy became the first major economy to test digital money. China has increased its attempts to roll out central bank digital money and is currently far ahead of its global peers. At this rate, China Digital Yuan will challenge the dollar's dominance as the preferred currency in international trade transactions in 10 years. The Digital Yuan pilot will compel major economies to implement CBDC plans as quickly as feasible to challenge the digital yuan as the world's reserve digital currency. With China years ahead in its thinking, the United States of America is playing catch-up, as President Joe Biden issued an executive order in March titled Ensuring Responsible Development of Digital Assets that established a series of 2022 deadlines for government agencies to assess the risks, opportunities, and national security implications of creating a central bank digital currency. I hope you enjoyed today's episode. Make sure you like and subscribe, and I will see you next time.
It was at this moment that Nathan knew he fucked up.
They found us! I'll cover you! Come!